All right, welcome back. So we're going to finish up our coverage of Chapter 5 by going through seller inventories. Sorry, seller journal entries. Sale of inventory in this case is the first one. So we've used the term compound entry to describe any journal entry with more than one debit or more than one credit. This transaction, the seller entry for the sale of inventory, is almost like a super compound entry because it has two debits and two credits that kind of go together. It almost looks like two journal entries stacked on top of each other. It is there really are two entries that happen simultaneously almost. And so here we're looking at the sale of inventory. So we've bought some inventory. We're selling the inventory for $2,000 and it originally cost us $1,500. And so our entry is going to have to account for both of those things. Here's the first part of the entry. The first part is pretty self-explanatory, something you probably would have guessed this would say from chapter 2, which is we're going to debit accounts receivable or cash and credit revenues $2,000. That's accounted for by this, the sales price of what we're selling. But we also have to account for the cost. And that's what this part of the entry does. So we're debiting cost of goods sold. Remember, cost of goods sold is our inventory expense account. Well, that's what this is. This is inventory that is now an expense because it's gone. We've sold the inventory. So the inventory is credited because it's gone. Cost of goods sold is debited because we have to record the fact that we have cost of goods that we've sold. And so this whole piece, these 4 lines, is our journal entry, one journal entry, for the sale of inventory. Now let's talk about sales discounts. As a refresher, remember it's a typical arrangement. It's going to say 210 net 30, same thing, blah, blah, blah. And that's the bottom line with all these transactions. Every transaction that we covered in video 2, we're covering the same transaction in video 3, but from the other side of the transaction. So if a company is buying inventory, that means another company is selling inventory. And so we've covered both sides of that transaction. Well, if one company is offering us is getting a purchase discount, the other company must be offering a sales discount. So here's an example. Previous sale, again, it was a $3,000 sale, or sorry, $2,000 sale with a $1,500 cost of goods sold. And so here is our entry. Note the difference in our entry. Instead of debiting accounts receivable $2,000 and debiting revenues $2,000, we're only going to debit $1,960 and credit $1,960. Note the difference between how we covered discounts in the second video versus how we're covering discounts here. In the first video, or second video, in video 2, we recorded inventory at the higher amount and then lowered the inventory number when we took the discount. Well, here we're doing the opposite. It's almost like we're assuming that we aren't going to take the discount as a purchaser, but we're assuming our customers are going to take it as a seller. And it's really kind of contradictory, but that's how we're going to do things. So again, note the bottom part of this entry doesn't change. We're still debiting cost of goods sold and crediting inventory. The top part is what gets changed as a result of our discounts. And then luckily when we get paid, it's easy because we're just going to debit $1,960 to cash and credit $1,960 accounts receivable and move on. So on the front end, it's harder for the seller side. On the back end, it's easier, and it's kind of the opposite for purchasers. All right, let's talk about sales returns. So this is super tricky. The thing that impacts us here is the revenue recognition principle and the matching principle. We're going to have to first estimate how much returns we're expecting to get. So if we have 400,000 of sales and we estimate 4% will be returned, how much is our estimate? Well, it's a pretty simple calculation. 400% times 400,000 times 4% is 16,000. And so once we have that estimate, we're going to make this entry. We're going to debit revenues and credit refunds payable. And first of all, what we're debiting revenues? That's correct. We're debiting revenues. We are going to decrease revenues. I know I told you in Unit 1 we're not going to do that very often, and we're not. This is the only chapter we're going to do it in. Every other chapter that we deal with revenues are going to be going up instead of down. But here is another an example similar to our closing, where revenues are going to kind of act funky. We're going to be decreasing revenues. But this makes sense, right? We expect that every time we sell, 4% are going to get returned. And so essentially we're under recording our revenues by 4% because of that estimate. Now, assuming that we have a 25% gross profit, which is what we had in our previous example, what is our cost of goods sold estimate for $16,000 in revenues? Well, if we think that we had if we've lost essentially $16,000 in revenues, that means we have $12,000 of costs that we're going to have to account for. So here's what we do. We're going to estimate returns inventory of 12,000, and we're going to credit cost of goods sold for 12,000 also. We're going to estimate returns of 12,000, and we're going to credit cost of goods sold also. Moving on to our next topic of freight. This is really a continuation of our topic from video 2, which is we started here. This is what we did. For freight in, for freight that we're receiving, we're going to be debiting merchandise inventory and crediting cash. But freight out is different. Freight out is different. We're not going to be adding to the cost of our inventory as it pertains to freight. We're going to be recording this separately as a different expense. Your freight expense, your delivery expense, it's correct. Your initial instinct was correct only when we're selling the product and paying for shipping. If we're buying the product and paying for shipping, we're adding it to merchandise inventory. And I cannot stress enough, there's like a couple spots on the exam where students get mixed up on these, and it's very important. If you want maximum points on the exam, you want these easy points to get that taken care of. All right, worksheet 3 is the last worksheet for this chapter, and it's all about, it's basically taking into account everything. It's got purchaser entries, it's got seller entries, it's got purchase returns and sales returns. Actually, it doesn't have any sales returns on it, but it's got everything you need to be ready for the exam. How about that? So take a look at worksheet 3. If you have any problems or anything, of course, you can always reach out to your instructor, and hopefully you make your way through this, and we'll get rolling in chapter 6.